Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters, and markets are mixed here as hopes of averting a government shutdown are dwindling. We're going to dig into that story further. But right now, there's just an hour to go until the closing bell. Let's take a look at the major averages. The Dow is basically flat here. The S&P 500, your broad gauge, that is up about 0.1%. You know, your tech-heavy NASDAQ also roughly flat right now. Let's welcome in our Washington correspondent. That would be Ben Worschel, plus our data and markets editor, Jared Blickery, joining us to break down all the headlines. Jared, kicking it over to you first for the day's trading action so far.
Got to say, for the last day of the month and the quarter, we're not seeing a lot of action in the major indices beneath the radar, though, beneath the hood. We will take a look at that in a second. We do have some action. Here's the Dow. A lot of chop here, mostly in the red, trying to turn positive here as it did earlier in the day, but not quite right now. Down about 3 basis points, by the way. NASDAQ Composite, very similar story. S&P 100, it's managed to climb into the green, but only up 8 points, or about 13 basis points right there. And let's check in on the Russell 2000, having a little bit of a rougher time, down about 2/3%. And the bond market, we got the 10-year in positive territory right now. It was down a basis point or two. We're going to call that flat, just a fraction of a basis point higher, up to 4.14%. The 30-year, 4.73%. That's up 3 basis points, so that's not nothing. But the U.S. dollar moving in the opposite direction of longer-term rates today, so that's down just a little bit. All in all, not a lot of action in some of the bigger markets that we track. But check out healthcare. It's been a while since I've seen that in the number one slot. That's up 2.5%, followed by industrials, staples, tech, materials. All of those outperforming the S&P 500 here. Then to the downside, we have energy down almost 1.5%, followed by financials, consumer discretionary, and communication services. Want to show you the NASDAQ 100, probably a little bit more red than green, but NVIDIA, look at that, up 2%. That is good for an intraday record high. Microsoft also showing some green there, but Meta, Amazon, and Alphabet, each of those down 1%. And if we take a look inside the semiconductor space, a lot of green here, not Intel, that's down 3%, but a lot of green most other places. And then software, kind of the opposite. Aside from some of the bigger names, we're seeing a lot more red. So once again, we see that bifurcated tech structure that we've been tracking over the last few weeks. What's not working today? China's another one, a lot more red than green. And I wanted to show you energy. And remember, that was the worst performing sector. No green. Well, excuse me, it looks like there's a tiny bit of green. Nordic American tankers, there you go. That's our bit of green today, but Baker Hughes down about 3.77%. Finally, when you look to big banks, not a haven there either. A lot more red than green. So interesting to see the indices kind of quiet, but structurally, there's a lot more red than green going on in some of the market components that we track here.
All right, Jared, thank you. And now to Washington, where lawmakers on both sides of the aisle are standing their respective grounds. Ben, catch us up on whether we're moving forward with a shutdown, Ben, and what we need to know.
Yeah, Josh. The short answer to your question of whether we're moving forward appears to be no. We've had a day here in Washington that's a whole lot of name calling and very little apparent progress, with a shutdown now about 9 hours away. As John Thune, the Senate Majority Leader, said just about an hour ago, there's nothing left to negotiate from his perspective there. That's because the Senate plan is for a series of votes starting at about 5 p.m. tonight that are essentially a rehash of previous votes, one Democratic plan, one GOP plan, both of which have failed previously. And the widespread expectation here is that both will fail again to reach the 60-vote threshold that would avert a government shutdown. After that, they're kind of out of options at this point for a shutdown, which would begin at 12 o'clock. President Trump earlier today called this shutdown likely. He also signaled plans that as he's been doing for days now, of sort of taking advantage of this shutdown to implement bigger cuts than we've seen in previous shutdowns. So that could increase the effects. He talked about, as a way to do political pressure, cutting programs that Democrats like. It's clearly to pressure them to concede. The question is how far he goes forward if we're in a shutdown situation tomorrow. Either way, we're having a lot of effects that we'll likely see if this shutdown goes forward, starting with furloughed workers, but looking ahead to the jobs report Friday, which will be delayed if this shutdown does proceed in a couple hours' time.
All right. Thank you, Ben. Appreciate it. To continue the conversation now on the looming government shutdown and what it means for markets and the economy, let's bring in Veda Partners Managing Partner Henrietta Treyz and George Young, Villery and Company Portfolio Manager. Welcome to you both. Henrietta, I will start with you. Odds of a shutdown, Henrietta. Where are we right now? What are you telling clients?
It would take a Christmas miracle to avoid it at this point. They're just not talking. I think technically I'm in the 80 to 90% range, but that is exceedingly high for me, and I don't see a lot of forward progress here.
Henrietta, can you remind us as investors what's on the line here?
Yeah, the biggest thing for investors is obviously, as Ben just pointed out, the 8:30 Friday morning employment situation for September. And the thing that's most striking here is that this is an active choice. This is a consequence of a shutdown. The information, the BLS staffers, Department of Labor staffers have all been working all month long to compile this data. We're going to get it all the way till midnight tonight. And really, they're just not going to turn the internet on and press send on that data on Friday morning. So obviously, it's a little bit more complicated than that. But on Friday morning, this information that the agency has is not going to become public to investors. And I think given what we've seen from BLS firings over the summer and the threats towards Lisa Cook and rest of Federal Reserve boards, there's a lot of attention on the integrity of the data amongst investment professionals, certainly a topic of conversation in every meeting that I have. So as we go forward, that's going to compound because the data that we would otherwise get reported throughout the month of October is also not going to be collected and won't be released. So that's probably the most market impacting development.
George, I want to bring you in here as well. You know, Henrietta brings up the reasons, the good reasons this should be on our radar as investors, George. But when you look at the market reaction here, honestly, George, it looks like kind of a giant yawn, and I'm curious what you make of that.
Well, I wouldn't quite say it's a giant yawn, but it is something that investors need to focus on. So building on what she had said about economic impact, I think it's important to look at what does this mean for investors and where might you be able to put your money. And if we look back to 2018, it lasted about 34 days. Not a lot of fun, especially for those who are government employees. On the other hand, this comment is really for investors. You need to separate from what you personally may feel as opposed to what you might feel in your pocketbook. So there's plenty of opportunities because going back to 2018, the market had a decent rebound and bonds did pretty well also. So you need to look at what can I do? How does this affect me personally? And where should I be investing? Long-term strategy.
Let me ask you, George, as an investor, if there was a government shutdown, how and where, if at all, would that impact how you want to put money to work?
Sure. Well, a couple things that make sense would be to look at defensive sort of plays, items that wouldn't be affected by the government shutdown. So something like Republic Services, which is a trash hauler, which is well known. They dominate in their industries. They've got 360 different recycling centers and trash pickup centers. They're very competitive. They've got low margins. It's kind of the play that would perfectly make sense through any sort of economic crisis. I think that's the way you have to look at things.
Henrietta, if there was a shutdown, how long could that shutdown last? And what are the variables, Henrietta, that would depend on?
Yeah, that's the question of the hour. So there's a lot of rampant speculation on Capitol Hill and amongst my former peers and colleagues that I speak with. And there's a possibility that votes could happen to reopen the government as early as Friday. It wouldn't be early enough to get the employment data out at 8:30 a.m., but it comes after the Yom Kippur recess, which everybody pretty much acknowledges right now they're going to be shut down for throughout Thursday. So votes again on Friday are entirely possible. My latest discussions with House and Senate staff suggest that votes in the Senate, at least, could occur throughout the weekend, and the House will get back on Monday. So this could be a very short duration shutdown. What you want to be mindful of is the October 10th date when every other Friday, federal employees get paid. There's going to be about 750,000 people who are furloughed here, and a good chunk of them get paid every other Friday. So when members are in session and they're voting and they're going to work every day, their essential staff is doing that also, but they're working for free. And the senators and the congressmen get paid. And that's true of the military as well. All the servicemen and women are going to work unpaid, as are everybody that goes to work at an airport, making sure that we're all safe. They are not being paid. So that tends to have a psychological impact on the members as they get back to the negotiating table.
George, I'm just curious, as you've been talking to clients recently, how much is a government shutdown coming up in conversations? How much is it, on that wall of worry for clients?
Well, it's interesting. It's sort of the worry of the day, because if you look back a couple of weeks ago, it was what was the Fed going to do? Were they going to cut interest rates? Obviously, twinning with that is what's happening with the different war fronts around the world. So, yes, our clients are concerned. The good thing for us is most of our clients have good trust in us and let us make the big decisions. But yeah, that's sort of the worry for the day. And I think it's one of those things where this too shall pass. We've seen this plenty of times before. It's the only difference right now is that you've got two sides of the aisle that really have disdain for each other, and that's going to be difficult in any sort of negotiation. So what I hope will happen is that emotions can take the back seat to doing what's best for the country, and that's what we elect our collective representatives to do. So hope that'll happen, but meanwhile, there are opportunities out there. This market still has room to run.
Henrietta, I'll end here with you. If there was a shutdown, I'm curious, who do you think the American public would blame, Henrietta? Would it be, would it be Democrats? Would it be Republicans? Or could it be kind of, pox on both your houses?
Well, Republicans are going to blame Dems and Dems are going to blame Republicans. That's what the polling data suggests. The difference is really in the independent voter, which, of course, is the critical and growing group of Americans who vote in regular elections. So there's a Morning Consult poll that they just put in the field of 2,200 American voters, and it finds a 13-point gap to the benefit of Democrats, thinking that Republicans are to blame going into this one. And I think that the rationale is probably that, the president is a Republican, the senators are Republican majority, and the same is true in the House of Representatives. They're Republican as well. So when they look objectively at what's going on here, they're blaming the majority party. That's the state of affairs right now. As I mentioned before, once you actually shut down, things start to go sideways and unwind pretty rapidly. I agree with George. This is a bad look for everybody. Certainly not what I voted for. So we'll see where it goes from here. But right now, the ball is in the Democrats' court. They got 13 points to run with. We'll see how long it takes them to get rid of that goodwill.
All right, Henrietta and George, thank you both for your time today. Appreciate it.
Great. Thank you.
Thanks, Beth.
Coming up, Pfizer agrees to offer discounted medicine on a federal website. We're going to explain what that means for the stock and consumers. Plus, can the market manage with a government shutdown in sight? We're taking a deep dive into how markets and investors have fared in the past. And Robinhood sets its aim on prediction markets and gets a big boost. We'll have that story and a whole lot more. Stick with us. Pfizer reaches an agreement with the White House to lower drug costs for Americans. Yahoo Finance's Jennifer Schonberger joins us now with the very latest. Jen.
Hey there, Josh. That's right. Pfizer has struck a deal with the White House to lower drug prices in return for not facing tariffs for the next 3 years, provided they increase their manufacturing in the U.S.
Pfizer has agreed to offer countless prescription medications at major discounts in the United States as a result of the most favored nation drug pricing order that we established earlier this year. As you know, the United States is paying sometimes 10 times more than other countries for drugs, and a lot of excuses were made for that, but it went on for many years, many years, decades, and it's not going on any longer. We're going to be paying the lowest price.
Pfizer CEO Albert Bourla also chimed in on what it means for his company to sell drugs at most favored nation prices.
Today we are turning the tide and we are reversing an unfair situation. The big winner of this deal clearly will be the American patient. There is no doubt about it. They are the ones that will see significant impact in their ability to buy medicines.
Drug makers were given until September 29th to comply with President Trump's executive order that required companies to sell drugs in the U.S. at the lowest price they sell in other developed countries, establish direct-to-consumer avenues, and not sell drugs for lower prices in other countries. The majority of Pfizer's primary care drugs and some select specialty brands will be offered with a 50% savings rate, with some savings on select drugs as high as 85%. Pfizer will sell these discounted medications themselves, as well as through a new forthcoming government website for consumer purchases of the lowest priced drugs, dubbed TrumpRx.gov. Now, Pfizer agreed to a 3-year grace period in which they will not be subject to tariffs under Section 232, provided they increase their manufacturing in the U.S. President Trump said earlier today that he expects deals with other companies in the forthcoming several weeks. Negotiations, according to senior White House officials, have been fierce, as companies' goal is to create shareholder value and wealth, and lowering drug prices doesn't exactly go towards that. As new drugs are launched in the U.S., they are expected to be launched at the lowest possible price, with drugs launched in other countries at higher prices. And a portion of the profits that these drug makers earn from companies, sales overseas, will be given back to U.S. patients, likely through the program of Medicare. And consumers can expect these lower drug prices to kick in early next year. Josh?
So, Jen, this Trump RX portal, could you just drill into that a little bit more, Jen? I mean, when does that launch, and how exactly does that work?
Right. So this is a brand new government website called TrumpRx.gov. It is still being worked upon right now, and the aim is to launch that in early 2026. And senior White House officials made very clear that the government is not getting into the business of drug distribution. What they're trying to do is basically create a website where consumers can go to this website, type in the name of the drug they're looking for, find the lowest price for that drug, but then the website would redirect them to the manufacturer who sells that drug, and then consumers can buy directly from the manufacturer themselves.
All right. Thank you, Jen. Appreciate it.
Washington is in turmoil once again, with investors wondering how a government shutdown can affect their money. That's what we're digging into on today's Stocks in Translation. A shutdown happens when Congress misses a budget or a short-term fix. Essential services keep running, but many others pause, as most federal workers are temporarily let go or furloughed. So let's break down what a government shutdown is and is not. First, it's a temporary funding lapse. It slows some services, and it can delay many data releases, like the monthly jobs report we're supposed to get this Friday. It can also delay federal permits and loan approvals. Just as important, here's what a shutdown is not. It isn't a government default on debt. Also, stocks and bond markets do not close. And essential services like law enforcement, transportation, Social Security payments, they keep on going. It's not the end of the world, but it can cause inconveniences. In the late 2018 shutdown that went on for a record 35 days, the SEC was unable to process paperwork, and that delayed both the Uber and Lyft IPOs by months. Now let's take a look at the actual market impact of the 11 U.S. shutdowns since they became a thing in 1980. We're going to start with stocks measuring the S&P 500. Here, each bar represents the median return for a different time period. And for the first two bars, they are the week prior and the day prior to the shutdown. And for after the shutdown, we look at the performance: 1 day, 1 week, 1 to 3 months, and 1 year following the shutdown date. And as you can see, the median returns, which are kind of like an average, they're pretty small until you get up to about a month after. We did see some pretty big reactions to the downside leading in the week of 1982, 84, and 2018, but the shorter time frames do not produce clear trends. But even in 2018, when the government shutdown went on for over a month, stocks were positive after a short initial drop. Translation: markets tend to look past the noise once the funding headlines fade. Now let's take a look at the long end of the yield curve, the U.S. 10-year Treasury note yield, which mortgages across America are tied to. Much like stocks, when you put all the results together and take the median, we don't see big changes in the week prior to the week after the shutdown. We did, however, see some big outliers in many years. So it's not like bond yields didn't react the week prior and after. There's just not a predictable historical pattern over the entire set. But once you start looking 1, 2, 3 months after the drop, you see consistent drops in long-term yields. In 9 out of 11 times, rates dropped 1 month after the shutdown started, with a median drop of 19 basis points, or about 0.2%. Finally, we also took a look at short-term movements in U.S. rates, which admittedly tend to move around Federal Reserve policy more than anything else. Once again, we see lots of big and small moves, both to the upside and the downside, from 1 week prior to 3 months after, which don't really produce any big trends. However, 1 year later, we do see some drops in short-term rates about 2/3 of the time, with a median drop of 39 basis points. Here's the roll-up. Stocks tend to be flat around the start of shutdowns. Then they climb higher 1 to 3 months out. But remember that stocks also tend to go up, so that's a big tailwind. For bonds, long-term yields tend to drift lower over 1 to 3 months, and short-term rates are mixed until they skew lower at about the 1 year mark. And here's what to keep an eye on. First, the continuing resolution path. That is a quick off-ramp to avoid or end a shutdown. 2, length matters. The longer the standoff, the more it can nick growth expectations and pull long-term rates even lower. 3, data delays. If reports slip, markets lean harder on data that's not coming from Uncle Sam. And finally, we do see spillover effects as federal contracts, small business loans, and travel and park areas, they can all feel the stoppage. Wrapping it up, shutdowns are politics loud and markets quiet unless they last. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Coming up, we're looking at leaders and laggards, top stocks that are making moves Tuesday. Stay with us for Trending Tickers. Right now, time for some of today's Trending Tickers. Yahoo Finance's Brooke DePalma joins me here for a look at like a little Robinhood, maybe a little UiPath, perhaps a little Instacart. Going to start off with Robinhood, the company releasing its September month-to-date trading metrics, showing about 187 million option contracts traded. This one was interesting, Brooke, and there was a good write-up on Bloomberg about this. So you were watching shares of sports betting operators, so DraftKings, Flutter, because Robinhood did post these September to date trading metrics, showed option contracts traded were around 187 million. Hood kind of emerging as sort of a rival here with, we know bettors allowed to trade contracts on sporting events.
Yeah, and their CEO saying that they have more than 4 billion event contracts that have traded on Robinhood. I think it's worth noting that when this first was sort of up and coming in, I think has been years now, but really the momentum behind it, especially as, gambling rules sort of relax from state to state. Of course, it's still not the case in some states. There's been this increased interest and Robinhood really taking advantage of not only getting into this, but also getting into crypto as well. And we've just seen Robinhood stock absolutely soar. Year to date, it's up more than 280%. This is one of the top performers in the S&P 500, if not the top performer in the S&P 500 year to date. And if you take a look over the past year, this stock is also up more than 500%. And so as Robinhood gets into these new niches that are really attracting a new audience, it's interesting to see how it impacts, that competition you mentioned, like a DraftKings, like a Flutter. And now with these sort of, contracts events and this prediction market as well, it's worth noting that who made that popular? Well, Polymarket this time last year around the election certainly made this idea of betting on overall events really, really popular, really an interest spot among consumers. And now we see Robinhood stepping into that.
Yeah, stock has been a rocket ship to your point.
Yeah.
And despite that, most analysts still bullish.
19 buys.
Yeah, that's it. Turning now to UiPath. Let's get that one too, because that company announcing a slew of partnerships, including ones with OpenAI, Snowflake, and NVIDIA. So UiPath make a robotic process automation software. They announced this collaboration, Brooke, with NVIDIA and OpenAI. And do investors really need to hear more than that? You just hear Jensen Huang, Sam Altman, buy 7%.
I mean, let's back up for just a second, Josh. So the stock is up 7% today, but if you take a look at the recent interest among investors, year to date up just 5% compared to a year ago, up just 4%. And compared to the company's performance all since it went public back in April of 2021, the stock is actually down nearly 80%. And right now we are just a bit away. Right now the stock's sitting around, as you can see on your screen, around $13.43. That's just slightly away from the 52-week high of $15.93. And so there is some concern on the street about, where exactly this goes. But certainly if you look at their press release page today, there's so much excitement. Those 4 announcements of them teaming up with these players as well. And so it'll be interesting to see where exactly this goes. I know that investors right now are really looking for results, but there are only 3 buys on the street right now.
Yeah, most are at a hold, right? Yeah,
18 holds and 1 sell. So
sidelines.
so most people on the sidelines waiting to see some return from these mega announcements. I thought it was interesting. 4 announcements within one day.
Big names. Big names. All right, lastly, Instacart getting hit with a downgrade over at BTIG, lowering its rating on that name. They go from buy to neutral, Brooks. So BTIG, they get lukewarm on this one. It sounds like flagging ongoing negative competitive developments. Amazon, DoorDash, Uber signing delivery deals.
Yeah, so just recently, DoorDash signed a delivery deal with Kroger as they look to get in on that. Of course, we've been constantly discussing Amazon stepping into that fresh delivery space as well. They announced that back in August, I believe it was. It's a company that continues to struggle to stand out. Year to date, this stock is down more than 12.5%. And largely, keep in mind, there's some mixed feelings on the street. There's about 17 buys and 16 holds, 1 sell as well. But this ongoing competition, it's not just Instacart or DoorDash anymore. Now it's Amazon looking into getting into fresh one-day delivery. We've also heard so much from Walmart, even Target doing same-day delivery. And so how exactly they plan to stand out in this competition, I think, is really something that the street is concerned about here.
Yeah, street fairly divided on what to do with Instacart. 17 buys, I see 16 holds, I see 1 sell. Brooke DePalma, thank you.
Of course.
Yahoo Finance executive editor Brian Sozzi caught up with Ford CEO Jim Farley at the Ford Pro Accelerate conference in Detroit to discuss boosting productivity for essential American workers.
Factory workers, construction workers, farmers, all the people that move things, truck drivers, rail workers, and people fix things, plumbers, electricians, HVAC, all the people that basically work for our hands. Think with their hands. Think of like Mike Rowe, all of Mike Rowe's friends.
I love Mike Rowe.
Yeah.
Why is there a shortage of these workers?
Well, it's a complicated problem, but there is, let's put it that way, literally 1 million people openings right now. Technicians in dealerships working on cars. At Ford, we have 6,000, probably 400,000 repair technician shortages across the economy. I think it's a couple things. First of all, the productivity has not caught up with the white collar. In fact, it's gone down over the last 20 years. Number 2, the jobs aren't as glamorous as a white collar job from college, which is kind of the primary path that our whole economy, investment was for new jobs. And I think the permitting and all the regulations has really stunted the growth of these kind of jobs. The one that I focus about the most is kind of the society's view of these kind of jobs. When a plumber, electrician comes to your apartment or your business or to your house, how do you treat them? Do you treat it because these people are running our communities. And so many people take them for granted.
You're the only CEO, from what I can tell in the past year, that is out here holding a summit like this, trying to get new skills into the next generation of humans. Why aren't more CEOs focused on real world applications like this?
I think it's because maybe it's more acute for a company like Ford. Look, the president has policies for us to grow. We make 80% of our vehicles in the U.S. We're the largest automotive company in terms of manufacturing and exporting. And so we have the shortage of mechanics. This morning when I woke up, there were 6,000 bays in our dealerships with no technicians.
So can't get my car fixed?
Nope. 2 weeks. Average wait is 2 weeks. Not because we don't have the parts, we don't have the mechanics. Same when we went through the strike and the UAW worker, we had a 2-tier wage. Most of our entry workers in our factories are working 3 jobs. We solved that with the new contract. They get full wages, but we still have that stigma of working in a factory. So I saw these problems firsthand at Ford. When I talk to my pro customers, they're all small mom and pop plumbers, electricians, HVAC that go into New York City and fix the elevators and the AC when it goes out. Those small companies don't have a next generation coming up. They're all worried, what are they going to do with the shortfall of skilled trades in this country? I guess we saw it first at Ford, and we're also a kind of company that doesn't like observing problems. We like fixing them.
What's the blunt reality if we can't get this fixed?
Inflation, delays. Right now, it's 10 years to build a bridge in our country. It'll be 20. You want all these data centers built? You got to be waiting, and it's going to cost a lot more than it should. And probably the bigger is the social cost of all these million jobs that could be great contributors to our economy that won't unless we do something. That's probably the biggest cost. When I'm 62 years old, I think more and more about that person, that million, one of those million people, how their life could be changed if they can be a mechanic at a Ford dealership, but they just don't know how to get from here to there.
President Trump has focused a lot on bringing back manufacturing to the U.S. Now, on paper, this sounds absolutely amazing.
Yes.
Well, what if we see that spike in demand and we don't have the workers to satisfy this?
Well, that's what's going to happen. That is what is happening right now. It'll be inflation. It'll be these projects take twice as long. I was talking to a construction CEO today, and he said, hey, this is a $4 billion, now it's going to be a $5 billion program. I just know, Jim, because I can't find, so I got to steal people, and I have to pay more, which is great to some extent, but that million gap is not going away. It's getting worse. I love the president's policies, but if we don't backfill it with real programs, that's what we're trying to do here today, real progress, we are just going to pay more and get more and more frustrated.
What are the programs you're putting in place to address this?
Well, we have apprentice programs. We're starting to work with charity companies to spin up trade schools. We need to do a lot more on permitting, so the company has to go in, not at the national level, local and state level. We have a lot of progress to make there, and we need to invest as a company in productivity for our essential workers. I want my factory workers to catch up and pass my white-collar workers in productivity. That means we got to give them AI tools, and that's going to cost more, but it's the right thing to do. But not all companies have the resources for us. If you're a small mom and pop company of electricians, you do not have the resources of Ford Motor Company. I'm not worried about Ford. We'll do the right thing. I can't wait to tell everyone what we're doing. But what keeps me up at night is all those companies that don't have the resources we do.
Why I love your earnings call, Jim, is because you keep it real. And you kept it real with this number. $2 billion net tariff impact this year. How does that make you feel as a CEO of a company like Ford?
I mean, it's frustrating because we're the most American auto company and we export the most, and yet we have this $2 billion headwind, which prevents me from investing even more in the U.S. So it's frustrating, but I got to tell you, we've had some really good conversations with the Trump administration. I know they feel our pain. I know they want to help us with this problem. What I've seen them do on the EPA side, really put the EPA tailpipe emissions more in line with customer real demand, that gives me hope that we're going to find a solution for that $2 billion parts bill.
Is the pain most acute in auto parts?
Yes, that's where it is. Basically, the tariffs should theoretically help Ford, whether it's bilateral from Japan or South Korea or Mexico or Canada. Our competitors make a lot of their trucks outside the U.S. I don't. I make 100% here. Theoretically, that's higher cost for them. The reality is, if you want to make it in the U.S., I have to import literally thousands of dollars of parts on F-150, the best-selling car in America, to make it affordable for people. It's already $700 a month. I don't want it to be $800. So that wiring loom or those fasteners that we don't even make in our country, I have to import. But I'm paying 25 to 70% tariff on those imported parts. It adds up to $2 billion. So that's what we're asking the administration for. Hey, help us make more in the U.S. by making these tariffs on the parts for cars more reasonable.
Last one before I let you go, Jim. You made a very powerful statement on stage, and I followed your whole EV journey. You said customers are not interested in $75,000 EVs.
Yes.
Is the reality that the EV market's just going to be smaller than people thought?
Yes. And I think we've learned. I mean, it's anytime there's new technology. If your Motorola and Apple comes along with the iPhone, things changed. When technology moves through an industry like electrification or software-defined vehicles are also changing our industry. We've learned. We've been number 2 to Tesla for 3 years, and we learned that people are not willing to pay $30,000 premium for that big battery on a $50,000, $60,000 utility. But they're willing to buy a $30,000 EV if they save $2,000 a year compared to gas costs. So the issue is we had to reload our capital on what we learned, move as fast as we can, and then we got to make sure we're future-proof to BYD. They have full support from the Chinese government. You know, they've been at this for 20 years. They have a lot of good IP. Ford has to innovate to catch up with BYD because we're a global company. We're going to compete with them around the world. Electrification is not slowing down in China. It's not slowing down in the rest of the world. Maybe here in the US it is, but not the rest of the world. That's why we developed this innovative universal electric vehicle platform that's $30,000 affordable EV.
Coming up, closer look at the AI trade and why one analyst thinks we're in the early innings of a 20-year AI supercycle. AI spending is showing no signs of slowing down. Jefferies now estimates hyperscalers and enterprise players are pouring more than $420 billion into CapEx this year. For more, we're bringing in Brent Till, senior analyst at Jefferies. Brent, always good to see you, my friend. You call this the early innings of a 20-year AI supercycle. Walk me through that, Brent. What gives you the confidence to make that kind of long-term projection? And are you confident, Brent, that at the end of the day, AI, it's going to be just as transformative, Brent, just as much of a paradigm shift as mobile, as cloud?
Hey, Josh, it's going to be bigger than all those. And the reason why is that every board across the globe is talking about it. The CEO of Ford is talking about AI reducing the white collar workforce. You look at the CEO of Medtronic talking about doctors. You don't want to get a doctor's appointment in the afternoon because the doctor's eyes get tired if you have a checkup. And AI doesn't get tired. And so this ability for AI to effectively do, those jobs across the board, this is going to hit every industry. It's hitting every boardroom. And we continue to think when we do the conversations about the ROI, we're really early. But why 20 years? If you look at the past cycles, whether we looked at cloud, we looked at internet, I mean, these mega cycles tend to last a couple decades. They're much smarter people than me, including Ben Horowitz, who recently gave a presentation that said this is a 25-year plus cycle. So I'm not the only one that's saying this. I think there are multiple, in multiple people in the tech industry that have been around for a long time that are saying the same thing. So we have confidence with 45 different meetings last week in the conversations, whether it was AI and healthcare, financial services, across every industry, that many of these industries are really early and we haven't really felt it in the enterprise. And so when you look at there's baby deployments, like we all use ChatGPT or Perplexity or one of the AI solutions on our consumer devices, but the enterprise really, we haven't seen it. And it's rolled out into basically like little units, little divisions, and we haven't seen a massive adoption wave yet. We think that hits in 26, 27. As those references get better, then they spawn a new use case of agents. And so we are a big believer that, again, this is a multi-year impact that's going to last a long time.
Brent, here that AI spending continues. Your combined CapEx estimate for the cloud giants plus Oracle and Meta now up 20% to $421 billion since the start of the year. Is that spending sustainable, Brent?
The spend is sustainable in the sense that we thought growth rates would slow, but the actual absolute dollars will go higher. We were wrong. We've actually now have growth rates accelerating this year, and you see, a number of these transactions. I think the fear is this effectively 5 companies just spending with each other. It's OpenAI and Oracle and a few others just spending, Meta spending with CoreWeave. Like you look at, there's a very tight number of names that actually could spend this amount of money. So the concern is, are we back in the 90s when Tom Siebel was doing deals with Hewlett Packard and Hewlett Packard was doing deals with Siebel? Like they called it barter transactions. They listed these transactions in their financial reports. So I think the worry is we've all seen this movie before where in past tech cycles, everyone's doing business with each other. I think right now, everyone's doing business with everyone because you can't get enough AI capacity from anyone. And the number one bottleneck is energy. And if you look at some of these energy names, including some of the nuclear names, they've obviously skyrocketed. So what we can see so far is that every vendor is saying they're capacity constrained, from Microsoft to Google to Amazon, and that those capacity constraints are not letting up. Microsoft had to push that out. So it's every company is talking about this. And it was interesting to hear, the CEO of NVIDIA, Jensen Huang, talk about, in the future, is it crazy to think that the multiple billions of people on the planet, do we all have our own GPU? And he said, no, it's not crazy to think that. And so I'm not here to paint a blue sky and everything's going straight up from here. What my point is, we think that there's a lot more gravitational pull and a lot more opportunity for this to continue to inflect. And at some point they will digest some of these investments, but we just don't see that yet because we see the demand much greater than the actual available goods. And everyone's saying they just can't find or capacity constraint everywhere. We just had the CFO CoreWeave at our AI week last week. And I mean, he was like, we're constrained at every level. And so until those constraints end, and by the way, it's not one vendor saying that, it's every vendor in the infrastructure trade saying that. And so until we see that get to equilibrium, then I think that we'll continue to say that, hey, we think there's more upside from here. And again, some of these multiples are not that crazy. They're really not that expensive when you start to look at Oracle. At this point, doing $20 of earnings a few years out, all you have to do is put a 20 multiple on it, and you're at $400. You can put a 30 multiple, and you'd be a lot higher. So I don't think we're in la-la land on some of the multiples on large cap. Clearly, we have names like Palantir and others that have gone to places we've never seen before. And that, again, I just don't see that in many of the other AI names that we cover.
So in that kind of, mega AI trade and trend, Brent, if you're looking for opportunities, if you're looking for smart place to commit capital, would these be your picks? It would be Microsoft, Oracle, Snowflake, Amazon, and CoreWeave?
Yes, that's it. And I think the application names that, Salesforce, Adobe, those names, investors remain underway. They see these OpenAI demos they just launched about customer care or doing digital signatures, and you start to see what OpenAI is saying, what Sam Altman's saying about wanting to get into SaaS or software as a service. I think that's freaking everyone out. So you're seeing a lot of money. You're seeing names like HubSpot down 10% today, Beret's down 10%, DocuSign down 11% in one day on the fear of OpenAI entering the application game. It doesn't matter what happens with AI, they're going to need infrastructure. OpenAI is going to need Microsoft, Oracle, CoreWeave. And so I think the conversation we're having with our clients is the application names are under duress. And I don't think it's as bad as the stocks are telling you, but no one wants to be there right now because there is no S curve. So software is kind of a tale of two cities. One side, there's zombies and trash and a crazy amount of debris floating in the air, and that's in the apps category. And then on the infrastructure side, it's like the sun's out, temperature's perfect, and everyone wants to be there. And I'm a little, that's been our view, stay overweight infrastructure. I think that trade lasts till 26 before we see money shift back to the broader software coverage. But right now it's, my group continues to underperform semis, AI infrastructure. And so I think investors will come back to these names at some point when they see an S curve or an inflection in AI revenue. We don't see that yet in the application names yet.
Brent, since you mentioned CoreWeave, and I have you here, I want to ask you, they did ink this $14 billion Meta deal. I want to get your thoughts on that headline, Brent. And also, you also cover Meta, whether you have any concerns, Brent, that you have these hyperscalers maybe are they becoming too reliant on kind of one key AI infrastructure name, Brent?
For many that know Meta's infrastructure, they would characterize them as one of the best builders on the planet of data center infrastructure. And the fact that they would go to CoreWeave tells you how good CoreWeave is. And that's all you need to know. Meta can't even keep up with their own plans to build their own infrastructure, and they need to go to CoreWeave to help them build that infrastructure. Same thing, Microsoft, CoreWeave, you've heard Google talk. So all the hyperscalers, all the consumer great, standout leaders in the internet are all turning to CoreWeave because they can't make their plans for AI deployments without the help of CoreWeave. And they are considered kind of the master luxury builder, if you will, of AI. And many ask, how long is this going to last? Like, what's CoreWeave's competitive advantage? And over time, I think CoreWeave's going to look a lot like Amazon AWS, which is it was infrastructure to begin with, and then it becomes a software story. And AWS is a giant software story. I think if CoreWeave can pull this off, I said this when Palantir went public, like if Palantir can go from selling really high-end, it was like Tesla, selling really high-end cars to then selling cars that nurses, doctors, can drive, the mass market can drive, then we're in a great spot. I think CoreWeave can get to the mass market over time, but right now they're winning the best builders in AI, and as long as these contracts keep coming, and we think they are, stock's going to keep going higher.
Brent, always great to have you on the show. Thank you, sir.
Good to see you.
We'll wrap it up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.